Mortgage rates officially hit over 5% as of today, which is April 5th. This is the highest rate that we have for mortgage rates since November of 2018. So in today's video, I'm going to break down all the latest details for you guys. I'm also going to provide an explanation about why mortgage rates have been increasing so greatly recently. So if you get any value out of this video, then please hit the like button. I greatly appreciate that. And let's go ahead and dive into the video. So this is the Mortgage News Daily, a great website, as you guys know, to track daily average mortgage rates across the United States. So right now, the average for a 30-year fixed rate mortgage is 5.02%. If you go down to this table here, April 5th, 5.02%. That's an increase compared to 1 year ago by 1.64%. In addition, we haven't seen rates as high since November of 2018. Which is quite remarkable. But what's really remarkable is when we look at this spike ever since the beginning of this year, rates have been increasing greatly. When we started the year, we were at just over 3.25%. Now we're at 5.02%, which is quite remarkable. One of the reasons why mortgage rates have been spiking greatly is because the yield on the 10-year US Treasury note has also been increasing. So right now the yield is 2.55%. This is almost a 3-year high, and this is one reason why mortgage rates have been spiking greatly. According to the Mortgage News Daily, rates have been rising rapidly in 2022 in general as the market quickly repositions for a big shift in Fed policy. The Fed sets short-term rates and buys long-term bonds. So in other words, they control the federal funds rate, which again is the overnight rate that banks charge each other. It's not mortgage interest rates. And they also buy long-term bonds, treasury bonds, and also mortgage-backed securities. Both actions impact rates across the board. In the past 6 months, the Fed indicated it would need to hike rates faster and reduce its bond purchases much more aggressively. And that's why rates have been increasing. But I have a lot more data to share with you regarding all this. Now today we have a bump in mortgage rates because of some statements from the Fed Vice Chair. She's typically more rate friendly than other Fed members, but today she offered a blunt reminder that the Fed bond buying program would be winding down more significantly and significantly faster than last time. And last time is 2017 to 2019. In addition, today we'll have the release of the minutes from the most recent Fed meeting, a more detailed account of all the voices within the Fed as opposed to the carefully worded policy statement from Jerome Powell. Markets are on the edge about just how troublesome that conversation may have been for their rate outlook. Is the Fed planning more bumps and simply pacing themselves? That's a concern pushing mortgage rates up and over 5% today. So here's an additional background regarding these statements from the Federal Reserve Governor. She said the central bank can raise rates more aggressively to dampen the high rate of inflation felt by Americans. She says currently inflation is much too high and is subject to upside risk. The committee is prepared to take stronger action if indicators of inflation and inflation expectations indicate that such action is warranted. She went on to say that additional tightening will be needed, adding that the Fed will also likely move in about a month to start shrinking its asset holdings, which could have the effect of further raising long-term rates. She added that inflation may not immediately abate, pointing to the war in Ukraine and COVID-related shutdowns in China likely to further exacerbate prices. The Mortgage News Daily is also reporting that 2022 has been the worst year for rates since 1994, and here's why. Starting in November, the Fed began reducing the size of bond purchases that began at the start of this pandemic. Those were mortgage-backed securities as well as treasury bonds. But November was a bit earlier than some of the market had expected though, and as a result, mortgage-backed securities suffered. Then in December, the Fed announced it would decrease mortgage-backed security purchases at a faster pace, and that caused mortgage rates to increase faster as well. Then on January 5th, 2022, the minutes were published from December's Fed meeting. The Fed was discussing shifting gears into the balance sheet normalization phase much faster than suggested. To make matters worse, the committee has been discussing a faster pace of rate hikes than markets had previously expected. The federal funds rate doesn't directly dictate mortgage rates, of course, as you guys know, but if the market suddenly expects more or faster hikes, interest rates tend to move higher across the board. And here's a chart to kind of visualize this scenario here. So this blue line here is mortgage bonds versus other bonds. Again, it's loosely tied to mortgage rates. So when this increases, so can mortgage rates. So when the Fed announced they were going to be tapering, that caused an upward pressure on bonds there. And also when the Fed announced they're going to be accelerating their taper, that also caused the uptick is there as well. Then again, we had the scary minutes from January that caused it to increase further. And then again, we had scary Fed speakers and inflation data, which also caused mortgage rates to increase during that time as well. As mentioned in this chart, scary inflation data is a problem for the Fed's rate hike outlook because controlling inflation is one of the Fed's two key policy goals. Incidentally, the other part has to do with full employment, end quote. But since there are more than 100 jobs out there for every 60 people without one, the Fed is understandably just focusing on inflation at the moment, which is running rampant, of course. When something happens that increases inflation expectations, whether it's a new economic report or war in Ukraine that indirectly affects the price of commodities like gas and oil, for example, or a pandemic that affects the price of so many other things, the market responds by adjusting expectations for Fed rate hikes. Those expectations translate directly to how interest rates are moving. So Fed speakers add fuel to this fire by confirming that the market is right to be afraid both of rate hikes and balance sheet normalization. This paragraph, more than anything else, sums up the big problem for rates in 2022. It goes on to say the following: to be fair, it wouldn't have been a problem if the Fed had been more aggressive in combating inflation in 2021, but policymakers were afraid of shortchanging the economic recovery when new COVID variant risks weren't as well understood. Even then, the Fed likes to move slowly and predictably. Unfortunately, that approach has proven to be extremely ill-advised given current market dynamics. That was already true before the Ukraine war, but doubly true afterwards. And here's a chart about where traders see the federal funds rate as of the end of 2022. As of the end of 2022, they expect the federal funds rate to be 2.25%, and right now we're approximately in the range of 0.25% to 0.5%. So they are forecasting for the Fed increase the federal funds rate in each of their meetings by at least 0.25% or 25 basis points. And they say this is extraordinarily fast shift in rate hikes expectations. With the federal funds rate currently in the 0.25% to 0.5% bracket, it would require 8 rate hikes in the standard 0.25% amount to hit the year-end target. However, there are only 6 Fed meetings remaining in 2022, so at least 2 of these meetings will require a 0.5% hike. It's been more than 20 years since we've seen a 0.5% hike. Now markets are expecting 2 of them in relatively short order. The net effect for mortgage rates is the fastest spike since 1994, assuming a time frame of several months. Here's something very important that they summarize in their report here. There is hope on the horizon, however. It may sound trite, but the higher the rates go and the faster they get there, the sooner the next period of relatively stability can begin. This can happen even as the Fed continues to hike rates because mortgage and treasury markets are making immediate changes based on future expectations. When the future plays out as expected, it doesn't imply any change to the rates we're currently seeing. And here's the key part here. Indeed, it's been the change in future expectations that hurt rates so badly. However, this does not mean that rates will stop and not increase further, but it does mean that they've clearly put in a lot of work toward reaching their next peak. Any additional surprises will depend on incoming data and events, especially inflation-related data and geopolitical events that greatly affect the outlook for growth or inflation. So comment below with your biggest takeaways from today's video. Also, if you got any value out of today's video, then please hit the like button. I greatly appreciate that. And also consider subscribing if you haven't done so already. Hope you have an awesome day, and I look forward to seeing you on the next video.